Thank you very much. Good morning. Nice to be with you here in Italian House on Columbus Day. Appropriate. Somebody's probably already made the joke. We're we're going to talk about Chinese outward direct investment in the United States here, but we're really going to talk about more than just that issue, because what that is showing us is what level of maturity Chinese companies are at, that they can now go beyond their own home court, their own home playing field. And it also says something about motive. Why, given that everybody thinks China is worth so much of the world's growth is, would anybody want to take money out of China to invest in our old, tired senior citizen markets in Europe and the United States, right? But it's happening, and so we're going to talk a little bit about why. I understand we have 30 minutes only, so I'm going to move very quickly. My slides are available to you if you want to go back and refer to them, or if you've maybe already seen them, that's fine too. Some of them you'll recognize from the readings I suggested to you. So this is where China is in the world economy today, just to give it sort of some context. About 21% of the world's people are the people of China, and about less than 10% shares of global exports and global imports, 7.5% to 8.5% there. GDP, now about 9% of global GDP. In a few ways, China is much bigger than its weight in terms of share of foreign exchange reserves held. 30% of all the forex held on the planet is held in Beijing treasuries. But in terms of outward direct investment, just 3.5% of the world total there. So it's not something that is well developed in China to date. And that's not unusual for a developing country not to have a lot of direct investment assets placed away from home. The difference, you understand, of course, between portfolio investment and direct investment. Portfolio investment, you call your broker and you say, buy me some treasuries or some gilts, or you issue gilt debt in Britain, I believe, right? So that's portfolio flows. That's easy. Direct investment, operating a company in Languedoc or Peoria or Indiana is very hard. It's not so easy. You have to do more than just call the broker. So that's why it doesn't happen so much for poorer countries that are just getting started. The red line here is China's share of global outbound direct investment, which includes merger and acquisition and greenfield. Both of those can be direct investments. And we see the U.S. here at the top. Europeans, some Europeans there in the middle. China, until maybe 2006, 2007, wasn't even on the map. It was virtually nothing in terms of global direct investment. And now it's maybe 5% or so, 4 or 5% of global direct investment, 3.5% in the most recent data we have. After 2005, 2006, the pattern changes. That's when we start to see China change. It goes from a mere few $billion a year of outflows to what we now have about $60, $70 billion a year of direct investment outflows from China. It starts in the mid-2000s, and the reason it starts is that China found itself horribly underinvested in natural resources. So while this takeoff starts half a decade ago in the mid-2000s, that was investment flow almost entirely going into natural resource operations, which harder than portfolio, calling the broker, but a lot easier just to dig stuff out of the ground, as they know how to do very well in China, compared to operating a white-collar, skilled labor-intensive operation in Paris or New York or something like that. So the takeoff had begun some time back, but it really wasn't coming into markets such as the United States. Here's the U.S., the stock of foreign investment in America by 2010, $2.5 trillion worth of inward FDI in America. That's not counting investment into financial institutions, which would sort of overstate the values a bit. Europe, of course, 70% of all the FDI in America. Asia, a much smaller chunk, 16%, and of that, China, 1/3 of 1%. So while people start talking about this issue as though it were so frightening, the Chinese are taking over, really, we have a very, very long way to go before China catches up to Belgium, let alone takes over the United States, right? But the story is starting to change. So I said after 2005, 2006, China starts to take off to the world, but it doesn't really start going to OECD economies like the US. By 2009, 2010, we do see by some measures it's starting to take off even into the US. From an extremely low base, we're talking tiny amounts of money compared to portfolio flows or compared to European investment in the US, but we're no longer, but it's the change in pattern that matters, not the amounts right now. This is a statistically significant change in what's happening in terms of China's interest in investing out into economies like the United States. There are important differences in how we talk about the numbers, so many different numbers here. Whether you just look at what the official foreign parent is in the balance of payments data, which would be these light blue lines, or you go do the research to figure out who the ultimate beneficial owner is. 70% of all China's outbound investment, according to their government, goes to Hong Kong and the British Virgin Islands. Well, guess what? That's not the destination. That's the first place you go, so you can obscure the tax and profitability and hide it from your Communist Party. So you get to keep all the money if you're a Chinese state company. Of course, the same reason that Enron went through the Caribbean. Same is why China goes to Hong Kong. So the actual number is much bigger, and as you'll see in a second, when we count up just the asset side, not the net position, it's even much bigger, twice as big as these numbers, in fact, if we set aside the liability side of the ledger. This is China's investment picture around the United States in 2003. I mean, it's just like a single-digit number of deals, maybe 10 deals total around the United States. By 2007, the picture looked like this. By 2010, the picture looked like this. Pretty significant change in what's happening. Again, small numbers to begin with, but there's a new era, a new phase on top of us that we need to understand. And already, people are starting to debate this the wrong way, very often, assuming that China's only going after high technology assets, national security problems, this kind of thing. When we start looking into the data our way, we find that the patterns are much different than what most people are suggesting. Let me say something very briefly about our methodology. So most of the research on this topic uses balance of payments information, which is compiled by the IMF, National Government of China, National Government of the United States. That data is useless for the Hong Kong reason I just mentioned. But even when it's good data, so on the US side, for example, the BOP data is better, but they intentionally don't tell us which industries, how big individual deals are. That's often business confidential information, and it requires the company, your company, other companies, reporting most of that, which is optional in many cases, to get a clear picture. So what we did was we went through and found every single deal that was announced in each of the past 10 years and created our own database using the FDI databases that investment banks use to get started, and then starting to develop relationships. We now have a relationship with 45 out of the 50 American state investment promotion agencies. Each state in America is now actively trying to get Chinese to come. And we're talking to those people. They don't want to be the last ones on the map, so they're telling us when a deal happens. So we're starting to get a different picture. It doesn't matter to us if Wanxiang Automotive, which is one Chinese auto sector company in Illinois, whether they brought the money from China or they borrowed the money from Citibank in Chicago, the project lending facility, to use to make an acquisition in America. We don't care. We want to know what's the value of Chinese-controlled assets in this economy. And we want to know what's the value of Chinese-controlled assets in Europe, the study we have coming out in about 4 months now, 5 months. That's not the official BOP way of doing it. You're only looking at money coming in if you're doing it BOP. You're not looking at money that could have been found locally. Also, in the BOP, balance of payments approach, if once Wanxiang makes that investment here, they make an intra-company loan back out to China, then that reduces their net FDI position in America. And surprise, surprise, that changes the story entirely, of course, right? So we look at the value of assets entered, contracted in the initial acquisition or the initial greenfield investment once it's begun, and we use those numbers to get a different picture. So when we do that, we get to add a lot of granular information along the way as we build the base. And we get, for example, we can see the difference between M&A and greenfield. The greenfields here in green, the merger and acquisitions in blue. Important things on this sheet are, first of all, 2008, 2009, 2010, and now 2011 as well, 130 to 140% a year growth. each of these years. So if anybody in Washington thinks, well, we will decide whether we're going to let the Chinese in, that's nonsense. It's a conceit. They think they're controlling this lever. The reality is most of these deals are not going to be blocked, cannot be blocked. There's not going to be any logic to blocking them. So that's first point. Second point is Chinese firms are able to do greenfields to a greater extent than we usually see for developing countries. Well, that's not a surprise. Shanghai is already an OECD economy. It's at the same level of South Korea, basically, competitively speaking, right? At the same time, you have this very big developing country that is the rest of China.
in which industrial sectors do they invest?
I'm glad you asked. We'll get to that in just a second. I'll tell you to the best of my ability anyway. We have the state-by-state breakdown in terms of amount of investment. So Texas in the lead, of course, Texas. I went to Texas undergrad, so it makes me happy. Just under $3 billion, 20 deals. Texas is big number because that's where Chesapeake, shale gas, and a handful of other big natural resource and steel deals now too. Tianjin Steel operating in Galveston. Likewise, Virginia is on the top of the chart because of AES, CIC investing in AES, right? One of your global peers, I guess, fair to say, yeah? New York is large because of Lenovo. A lot of corporate domiciles in New York. Delaware is higher on the list as well because it's a corporate domicile. So here's the industry picture to the best of our ability. We've colored pink and blue between manufacturing and services to give you a quick sense when you look at the graph that it's a broad spectrum. It's not just service investments. It used to be just investments in warehousing, operations, trade facilitation, offices designed to write invoices and do fulfillment, stuff like that. That's not the case anymore. The higher up you go is the larger amount of investment. So industrial machinery, equipment, and tools at the top. The further out this way is the number of deals. So you have lots of sectors that have smaller deals, but more of them, of course, right? And then the size of the circle is the average deal size. So that's you guys, the big blue dot there. In your space, utilities, you get larger transaction sizes taking place, although very few of them, right? Hence, it's toward that side of the chart. We now have had AES, Entergen up in Massachusetts, which closed in the second quarter. Interesting because the stake that Huaneng Power bought out was bought out from an Indian company. So it was already held by a BRIC. It just got transferred to another BRIC, Chinese BRIC. Nonetheless, some would have thought the US would have tried to impede or block that deal. We did not. We let it go through. Every reason we should let it go through. Briefly then, we can also look at whether the companies are government-controlled Chinese companies or not. Some amount of judgment is needed to do this. We use a 20% threshold. So anything more than 20% Chinese ownership, we call it a government ownership, we call it a government company. Less than 20% government ownership, we call it a private or publicly held company.
What do you mean by greenfield projects?
There's two categories of direct investment. There's merger and acquisition, which means I buy GDF. Okay? It already exists. I don't. The Chinese do, right? They just did. It already exists. They're not building something new. They're acquiring an existing asset. Greenfield is I'm bringing money in to build something from scratch for the first time. That's the difference between yeah. So we see here in terms of control that in the number of deals being done, 70% are not government Chinese companies. By the value, because the government is more heavily represented in the capital-intensive industries, 66%, this is the government-related firms making these investments. There's many controversies. Huawei Telecommunications is a private company, and yet it's being treated in the United States as though it were government. Lenovo is now a private company. The government entity which helped create it has sold its shares out to American and other hedge funds over the past years. It's now no longer a government firm in our estimation. So the 2011 pattern we see is holding up this growth, second highest ever in the second quarter of 2011. This is the new normal. It's not just one occasional high quarter from a big deal. It's every quarter is $1 billion or more of deals, and that's continuing to grow in magnitude very quickly. This is the European picture, by the way, which, as I mentioned, we have a new research project similar to our US work coming out in about 4 months' time. We can come back and talk about this in a second. This is where the breakdown is in terms of European flows using our methodology. UK, not surprisingly, given London as a deal center at the top. Hungary at the top because of a handful of big industrial transactions. Similarly, Sweden because of Volvo and a few other deals. I thought you might find this of interest, although you know more about this than I do. We just threw this into the presentation last week. I haven't, my colleague Thilo Hahnemann put it together for me. This is all deal activity globally by Chinese investors in your space and in your business. So we have your GDF at the top here, 2S Power in Singapore, AES and Entergen, American deals I referred to. We have some Brazilian investment assets, State Grid company, a typical kind of investor there. As you would have seen in the second quarter second quarter update I suggested to you, we've made some comments on why we think Chinese are so attracted by global generating assets. It's because they've got lots of cash in China, but the market structure is so oligopolistic in China, there's nothing they can do with their cash at home except build more hotels and restaurants, and the government's telling them to stop building hotels and restaurants. And so they're going out and investing in what they understand, which is the annuity-like returns on generation assets around the world. That's the way it seems to us. I'll finish up here because I know we only have 10 or 15. Yeah.
One comment.
Go ahead.
I'm a bit, I would say, surprised by this interest, because if you want to stop or to, in a way, to reduce Chinese investment in the US, it's much easier to change the regulation in these sectors as opposed to just prevent the deal to happen, right?
Absolutely. And so the notion, you know, if the United States is trying to stop Chinese investment, we're not doing a very good job, are we? In fact, we're not trying to stop Chinese investment. There are some here who would like to do so. There's some here who would like to think we could. I'm not sure we can. And there are many, many, many people in China who think that the US is closed, and that's their excuse for not having much operation outside their own economy. But of course, that's just an excuse they're making. The real reason is they don't know how to operate in France or the United States because it's very difficult. There are actually tax obligations, there are environmental obligations, there are human resource obligations, there are compliance obligations that a typical Chinese company has no understanding of whatsoever. So that's the main reason why they haven't been here yet, not the notion that somehow the United States is not letting them
just on
in.
that previous diagram, I was
Yeah.
surprised to see that the acquisition by Hong Kong utility of EDF Energy's assets in the UK, which was $4 billion, isn't on that.
Well, it's a Hong Kong entity,
Yeah.
so we're only counting mainland Chinese ultimate beneficial owners. So if that's better understood as a Chinese company, a PRC company, than a Hong Kong company, then we should have it here. And please, to the extent that we're smart on this topic at all, which is barely, it's because we interact with business people who help us to fine-tune and improve our snapshots. So I hope that we'll have a dialogue to follow up on this. We have a lot more work we are about to do on Europe in particular, and I'm sure that some of you could probably make us, prevent us from making some mistakes. So let's keep the conversation going after today, but anyway, that would probably be the reason why that deal's not there.
Actually, the case is it's a decashing company.
Yes.
So should it be?
No, not really. No, we would treat that as a Hong Kong company. We don't count Hong Kong investments in our deal flow. We could. There's a good case to make, but if we did, then our numbers would be more debatable. We only want to know what's the bright red commie number look like. That nobody can argue about. You know, maybe it should be bigger because Hong Kong should be there. Maybe Taiwan should be in there too. You know, you could make a case, but we want to make it as simple and straightforward as possible. If we're concerned about Beijing control, then let's just look at the stuff which is, you know, incontrovertibly Beijing. Let me ask, will we have like an extra 5 minutes or so? I want to make sure I preserve enough time to show you everything we've got. So the next big question we need to spend a minute on is motive. Why is this happening now? Policy, there have been a number of encouragement policies going back over the past 15 years or more for Chinese firms to go abroad. None of them correlated with a takeoff in outbound investment, except most recently we've seen this happen. So I would say that policy is important. Policy can say no and make it hard for companies to go abroad, but policy cannot make Chinese companies go abroad. Unless there's a clear profit motive that companies can identify, they're not going to do it, even state-owned enterprises. We have tracked state-owned oil companies of China refusing to bring oil home from the Sudan when there's not a high enough pump price for gasoline in China. So if global barrel prices are higher than the recovery on refining for petrol and diesel, then PetroChina will make up excuses about refineries being down, and they'll sell the oil to the Koreans and the Japanese, even when they're ordered by the central government to bring it back. So that's typical Chinese SOE behavior, and they're not going to go try to invest in America unless they can be clear how to profit by doing so. What is having an effect on them is this reality. This is just kind of a discussion slide here. This is the global production chain from upstream, both in upstream technology, resources, to manufacturing and assembly, to distribution and retail. This is where China is in the red curve. Factory to the world, sure enough. But where's the profit margin going? Profit margins have been compressed in this manner, so that manufacturing margins are getting thinner and thinner and thinner, and design and resources, as you well know, are getting richer and richer. And also customer value, what Steve Jobs perfected down on that side, is terrific business to be in if you can do it. It's not where the Chinese are. So this has created an incentive for Chinese firms to move up and down, looking for a way to shorten the time it will take to get out of the margin squeeze that they're in. That's a powerful force here. There's macroeconomic factors at work, structural factors at work as well, from the changing cost of operation in China. Here we just have two considerations. People talk quite a lot about this red line, which is the appreciation of the renminbi, which is changing the light manufacturing competitiveness of Chinese firms, right? And that's on this axis here. So if we want to look at it since 2004 or so, we've had against the dollar an effect of about 18% appreciation of renminbi in nominal terms, right? The blue line is wage cost. And since 2000, this is the index, this is the axis that describes the wage cost change. 250% change in a decade in wage costs. So which one is more important? It depends on the industry, of course, how labor intensive they are. But there's more than just an exchange rate issue. There's labor issues, there's environmental compliance issues. There's whether you can actually do innovation in China. These things are structurally changing Chinese competitiveness and creating incentives to go abroad for the first time in a real way. There's a long list of controversial deals which did not succeed in the United States for one reason or the other, and I'm happy to talk to you about those for a second if that's what your interest is. But I would say, in general, that you look at the Committee on Foreign Investment in the United States, which is the national entity which screens to see if there really is a risk. The number of Chinese deals that they have reviewed, doesn't mean they rejected, it means they reviewed, is of course small compared to the number from economies where we get a lot of investment from. Having a lot of review doesn't mean we don't like you. Having a lot of review means there's a lot of investment coming from your country. It's that simple. We've had more trade disputes with Canada than any other country in the world. Does that mean we have a bad relationship with Canada? Or does that mean we have a deep relationship with Canada? We have a deep relationship with Canada. So it's part of success that there's more of these reviews for security considerations. China is not Canada. And there are national security concerns which are far greater in the case of China than there is in the case of Canada, I can assure you. However, we're allowing deals to go through in electricity, Jen, in shale gas and other natural resources, and aviation and aerospace. Two major deals so far this year and several more on the way. So it's certainly not the case. If we're trying to keep Chinese out from sectors that we could make an argument, we're not doing a good job of that because we're actually not trying to do that. Let me stop there, and we have maybe eight minutes perhaps for a discussion, 8 or 10 minutes. unless I've covered everything and there's nothing left to discuss.
What's the political environment like? One of the secrets to attracting inward investments is actually that politicians welcome inward investment.
The political environment in the United States, right? So, at the state level, it's getting quite positive, I would say. There's a serious effort in almost all the states now to promote themselves and market themselves as destinations for investment. So much so that there's starting to become some tax competition problems. Alabama and Arkansas have had a little mini war, a little civil war down there over tax breaks offered to try to get Chinese investors in, for example. At the national level, people are still trying to play the China card as a scary thing. Yeah? Romney did it in the debates so far. It's starting to happen in the campaign. But really, it's not happening that aggressively as you would think in terms of the political campaigning. I think certainly we're going to continue to see the Congress trying to get in the way of deals, trying to block deals. We're going to see the defense community and the intelligence community make as much trouble as they can in some sectors, for example, telecommunications, with Huawei having a horrible problem. But at the same time, the numbers speak for themselves. 130, 140% a year growth in inflows. You know, look, that map of the states getting redder and redder and redder as deals pile up and deals pile up. It's getting a little less frightening, I would say. So I think the politics, you know, are going to continue to be highly problematic in some sectors, telecommunication in particular. But the story at the same time is going to be one of more and more deals happening successfully.
One of the political issues in foreign direct investment usually is do the foreign firm bring their own management or do they let the local manage? How do the Chinese practice in the U.S.?
That's a good question. And of course, under U.S. inward investment policy, the only thing we're looking for is national security. What the economic implications are is really not supposed to be a consideration at all. And for the most part, our system does work blind to what the competitiveness implications are, unless there's some strategic issue that connects to it. In terms of how the Chinese are operating here so far, it's, I think, a little too soon to tell. After all, this whole database that we have is about 320 deals now or so. So we can't necessarily draw too many conclusions from that. Chinese government is telling their companies to use foreign partners, to do JVs, not to try to do things 100% for the most part, because they need the skills, they need the local know-how. I've talked to people at many of the human resources consultancies, like Mercer Group is one that operates here, and they used to have an impossible time trying to get Chinese clients, firms, to buy their services to do a HR strategy for a US investment. Now it's not so hard anymore. A number of the deals in this database, after they acquired a US going concern, all the management left. Because they said, well, you know, the Chinese own this company now, it's not going to be the right place to work. We're going to go someplace else to work. And they could do that. If they started the company, they just got their $10 million or $50 million or whatever, and then they took the money and left. And the business failed, or close to failed afterwards, because the Chinese didn't know how to run it in the US. So they started understanding they have to offer retention packages to keep management in place after they make an acquisition. So JVing, retention strategies worked out with consultants and advisors, these things are starting to show up after the initial wave of sort of mixed experience, I would say. In some of the deals, for example, the Chesapeake deals, interestingly, CNOOC has sort of intentionally not put technicians into those operations in the United States because they didn't want to create the appearance that they were just here to grab some shale gas fragging technology and take it home. They're going slow in terms of moving in Chinese technicians and engineers. Depends on the politics, I think, and the advice they're getting from their advisors, whether that would be the case in any particular deal.
What is the link between all of these acquisitions and the fact that you have so many Chinese studying here in the States?
The link is the deep, rich potential of the mature economies. You asked me about the United States, so I'll talk about the US when we could say the same thing about Europe. Until presently, the number of invention patents filed by all Chinese companies every year is fewer than the number of invention patents every year from the state of Vermont. From the state of Vermont. There's lots of junk patents being filed now, patents that aren't really major innovations from China. But in terms of real innovative potential and capacity, there is so much potential in the US, in Western Europe, in Japan. The problem is the demand, future demand there to justify all the sinking of cost up front to make use of those assets, that research potential and capacity, I think. And that's another question, maybe the one that Bubala was talking about a little bit, you know? But for the time being, just how fertile the soil here is, the terroir, if you will, of the American economy is just incredibly, incredibly valuable, especially for it's complementary to what China has. China has the low labor costs, it has the demand potential for the future, it has a lot of capital even. What it doesn't have is a lot of process know-how, human capital, sophistication, innovative experience. And so that's bringing Chinese students to Columbia because they think that just by being here somehow they'll get that. Now I have many in my class here and I'm not so sure. And they have a hard time with my tests because they answer the question the same way as said it in the textbook, but they get a C plus or something like that and they're very upset. I say, no, I didn't want you to copy out of the book. I wanted you to analyze and tell me what you thought this meant, you know, and that's just an alien concept. So, you know, we have one of life's you know, compensation for getting old is that you get wiser, hopefully, and you have some assets that can be put to work even when you can't run as fast as you could when you were at China's level of economic development. So, one more question, perhaps, or not? Well, I do hope that a few people from the group with an interest in this topic will get my email either from the slides or otherwise, and maybe we could have a little dialogue. I'd very much like to send you, if you don't already have it, the table of global investments in this space, in your space, generation, and have a little back and forth with you to see if there's some additional value we can squeeze out of the connection with each other. So, with that, okay, have a terrific conference. Thank you.